Everybody, it's Sebastian here from Wealth Depot. Thank you for spending time with us today. In this session, I wish to recap one of the most significant superannuation reforms that will take effect from 1 July 2017. The government has passed a law to limit the amount of capital an individual can transfer to the retirement phase of superannuation. For the 2017-18 financial year, this cap is 1.6 million. So how does the transfer balance cap work, and how can it affect your retirement plan? Let's discover further in our webinar today. Before looking further at today's presentation, I wish to advise you that the information provided in this video presentation is general in nature and does not take into account your personal circumstances. You should seek professional advice before acting on any recommendation. So, what are the changes? From 1 July 2017, the government will limit the amount of capital that a member can transfer into the tax-free retirement phase. For the 2017-18 financial year, this transfer cap is $1.6 million. The cap is indexed in $100,000 increments in line with the Consumer Price Index. It's important to note that the transfer balance cap does not take into account your investment growth, losses, or pension drawdowns. Hence, if you transfer $1.6 million into the pension phase and later this balance increases to $2 million due to investment earnings, there is no breach of the transfer balance cap. If your superannuation account balance is greater than the allowable transfer balance cap, the excess amount must stay in the accumulation phase, where it will be taxed at 15%. The government will use a proportion method to determine your unused transfer balance cap. We will look at this proportional indexation in more details in the subsequent case study. So here we have Nathan. Nathan first becomes entitled to superannuation income stream benefits in the 17-18 financial year. Nathan's transfer balance cap is $1.6 million. If Nathan transfers $1.2 million into the tax-free pension phase, he will have used 75% of the $1.6 million personal transfer balance cap. Assuming that the transfer balance cap is indexed to $1.7 million in 2021, this does not mean that Nathan will have $500,000 of unused balance cap left. Instead, proportional indexation of the unused cap means that Nathan's unused transfer balance cap is $425,000, 25% of $1.7 million. Therefore, Nathan can contribute $425,000 without breaching his personal cap. The transfer balance cap is measured by way of a transfer balance account, which works like a bank account statement. Amounts an individual transfers to the retirement phase give rise to a credit in the transfer balance account, while certain transfers out of the retirement phase will give rise to a debit. The transfer balance account is created when credits first arise in the account, or in other words, when the member first receives a superannuation pension in retirement phase. The transfer balance cap is breached when the transfer balance account exceeds the personal transfer balance cap. As demonstrated in the diagram above, notional earnings obtained from the excess balance will be added to the credit of the transfer balance account. So what counts towards the credit of a transfer balance account? The main credits to an individual's transfer balance account come from the values of existing superannuation pensions as at 30 June 2017, and new retirement phase superannuation pensions commence after 30 June 2017. In addition, reversionary superannuation income streams and notional earnings accrued on excess transfer amounts also add to the credits of a transfer balance account. I would like to emphasise here that if a member arranges for a superannuation death benefit pension or a reversionary pension to be paid to a spouse when the member dies, the value of the pension will be added to the surviving spouse's transfer balance account. If following the reversionary pension, the surviving spouse's transfer balance account exceeds his or her cap, the government will allow a 12-month grace period to reduce the transfer balance account to within the allowable caps. Also, it's important to note that investment earnings or losses will not affect the transfer balance account. Similarly, periodic drawdown of superannuation income stream benefits will not reduce the member's transfer balance account. Let's explore some case studies now to understand more about how the transfer balance account is credited. So here we have an example here with Carly. On the 1st of September 2017, Carly starts a pension worth $1 million. On 1 July 2019, the value of Carly's pension grows to $1.2 million, owing to the investment earnings. By 1 January 2028, Carly has withdrawn the full value of her pension account. At all times, Carly's transfer balance account is $1 million, which is the credit that occurred on 1st of September 2017. Investment earnings of $200,000 and the pension drawdowns are not included in Carly's transfer balance account. In this example, Jason has a reversionary pension worth $800,000 at the time of his death on 1 July 2017. The pension reverts to his wife, Valerie, who has a transfer balance account of already $1.2 million. In November 2017, Valerie is advised that she became the recipient of Jason's pension, which will increase her transfer balance account to $2 million. Thus, Valerie has breached the cap. To rectify this problem, she can fully commute her pension or partially commute the excess component of $400,000 to an accumulation account, or withdraw the amount altogether out of the superannuation regime. In December 2017, Valerie partially commutes her pension and receives a lump sum of $400,000. Her transfer balance has now reduced by $400,000 accordingly. The $800,000 credit from Jason's reversion pension arises in Valerie's transfer balance account in July 2018. At this point, Valerie does not breach her transfer balance cap. On a side note, it's important to be aware that from 1 July 17, partial computations of super pensions will not be counted towards the minimum pension payment requirements. So we have looked at what can increase your transfer balance account. So on the other side, what can reduce it? Your superannuation income streams can be reduced when you commute it into a superannuation lump sum. This lump sum can be retained in the superannuation environment in the accumulation phase, where it will be taxed at 50%. Otherwise, you can withdraw the lump sum out of superannuation altogether. Computation of superannuation income streams will give rise to a debit in your transfer balance account. In other words, it will reduce your transfer balance account accordingly. It is important to note that just as investments gains are not credited towards your transfer balance account, investment losses will not be debited. So if you have used up your 1.6 million transfer balance cap and your account falls to 1.5 million due to investment losses, you will not be able to transfer an additional 100,000 to top up. Ordinary pension payments will not be counted towards the debit of a transfer balance account either. Under certain circumstances, the amount of a debit can exceed a member's transfer balance cap. If this is the case, the member will be able to start a new income stream up to the value of the fully commuted superannuation amount without breaching the cap. As the change is drawing close, it is important for members and SMS trustees to review their pension arrangements prior to 30 June 2017. If the pension balance exceeds the transfer cap of 1.6 million, prompt actions have to be made to rectify the excess and avoid paying extra taxes. You have two options: either to roll over the excess back to the accumulation phase, where 50% tax will apply, or withdraw the amount completely from the superannuation environment. Cautions need to be made to ensure that the chosen option provides the best outcome for your retirement savings and is suitable to your investment strategy and goals. A superannuation may have to find ways to dispose assets to comply with the 1.6 million transfer cap. The government provides transitional CGT relief to reduce the detrimental impacts on mass sales of assets. These provisions are complex and out of the scope of this presentation, and we highly recommend that you contact your tax advisor should you have any concerns. Finally, the 1.6 million transfer cap may create problems when it comes to estate planning. As previously mentioned, reversionary pensions will be credited to the surviving spouse's transfer balance cap, which may lead to a potential breach of the transfer cap. The problem can further be exacerbated if an illiquid asset, such as property, is held within the retirement phase. In this case, there is risk that the property may be sold in order to cash out the deceased member's benefits. Overall, it is important that you contact your advisor or accountant to review your pension arrangements in light of upcoming changes as soon as possible. To wrap up our presentation today, I wish to go through some other superannuation reforms that were passed by the Senate on 22nd November 2016. From 1 July 2017, the concessional contributions caps will be reduced to $25,000 regardless of your age. Super members should take advantage of high concessional contributions this financial year, which are $30,000 for people less than 49 years of age and $35,000 for people aged 49 and over. Secondly, the government has introduced a catch-up regime for those with total super balances of less than $500,000. Under this regime, members can make use of the unused concessional contributions cap space on a rolling basis for a period of 5 years. Amounts carried forward then have to be used after 5 years will expire. Only unused amounts accrued from 1 July 2018 can be carried forward. So just to recap there, amounts carried forward that have not been used after 5 years will expire. Thirdly, as this is a positive change, the government has removed the 10% test where it comes to claiming deductions on personal contributions. Fourthly, as mentioned in our previous webinars, the non-concessional cap will reduce from 180,000 to 100,000 from 1 July 2017, with transitional rules apply to those who triggered the bring forward rule prior to the 1 July 2017 date. Some other important updates include the removal of the tax-exempt earnings for TTR accounts, which may trigger the need to consider the necessity of setting up a transition to retirement income stream, the replacement of the low-income superannuation contributions, abolishment of the anti-detriment payments, and the amendment to the Division 239 for high-income earners. Overall, we hope you enjoyed our presentation today. Thank you again for your attendance. Talk to you soon.